The market has some pretty interesting problems right now that not a lot of people are really fully understanding or grasping. And there's some things that you guys, as viewers and participants in the market, need to know in order to best position yourselves going into the end of the year. Now, typically September is one of the worst months for stocks. And when you combine that with having another FOMC meeting, more inflation data that is going to get released, and all of the other economic indicators that we have been watching over the last couple of months, things could be about to get really interesting. So again, guys, before we get into all of that information, make sure you guys drop a like down on this video here. Helps out a whole lot with the algorithms, and subscribe if you guys do want some more videos like this. But let's get right into this here. When we take a look at this first article right here, this little snippet, Neil Kashkari is happy to see the stock market's reaction to Jackson Hole. Sharp stock market losses show investors have got the message that Jerome Powell and his colleagues are serious about tackling inflation, said Minneapolis Fed President Neil Kashkari. I was actually happy to see how Chair Powell's Jackson Hole speech was received. Kashkari said in an interview with Bloomberg's Odd Lots podcast Monday, reflecting on how on the steep drop after Powell spoke, people now understand the seriousness of our commitment to getting inflation back down to 2%. This is an incredibly important statement that you guys really need to understand, and let's just kind of break this down here. So there's been kind of a debate on whether or not or to what degree is the Fed really credible in trusting what they are going to be saying. Now, again, the target rate that the Fed wants to get back down to for inflation is 2%. Now, with the statements that Powell made last week, it is now pretty obvious that he's going to go on the more hawkish route. Remember on the videos last week, we were thinking, well, we are seeing that declining GDP. We are starting to see the housing market really starting to slow down. Inflation is still running really high. Is the Fed going to kind of take the foot off the gas and start to kind of ease off and attempt that soft landing? But with the statements that have been made and the kind of reactions that we are seeing in the market, and then the statements from Kashkari here, it's pretty obvious that the Fed not only wants to see inflation come down, but they are going to kind of do everything in their ability to see that happen. Now, what is that going to entail? Now, when we come over to the market right now and we take a look at the SPY on the daily time frame, there are a couple of key things that we need to understand. One, we are hunting this 1348 cross down on the daily time frame. The last time that this happened was back in April, and the significance of this move down was, let's just say here, you were playing it under the 200 EMA all the way down here to the lows, a 16.5% decrease in the overall market here. So technically speaking, if we start to break these levels of support down here, if we start to slip 400, 393, we are in for some pretty volatile and bloody markets. And you guys as retail investors need to understand how to fully take advantage of this. Are you going to be learning how to trade options to hedge yourself on the downside by buying puts? That is something that we talk about each and every day in our group, teaching people exactly how to navigate these markets. But if you're not necessarily an individual that wants to learn options or go out and directly short stocks, you have those inverse ETFs. You could go on the volatility indexes, SQQQ, some things like that that are going to kind of hedge you to the downside. But as a retail investor, information is incredibly important. The information that you are receiving, you have to be able to analyze it and kind of determine whether or not it's going to be factual or just blowing smoke up your you-know-what from the news media. So what we're seeing right now is we're kind of at a breaking point. We saw this big, massive red candle coming off of the Fed here, and we're starting to see that slow bounce up. Again, we are still red on the day at the current time that I'm recording this, a pretty flat consolidation day overall in the market here. But again, in general, when you think about this in terms of a quarter-long investment horizon, 2 quarters, 3 quarters, even a year out, we are not out of the woods yet. And again, guys, if you do want to actually learn how to take advantage of all this opportunity in the market, make sure you check out that link down below. It's the best place to come and learn how to trade. We have the only really powerful retail investor geared algorithms that you guys can use every single day on the daily time frame, the 5-minute if you want to day trade. The daily one's going to be more for the people that just want to trade shares. Maybe you want to trade options with it too, but we have the full learning curriculum out there to help you break that down and use it 100% effectively. We have all of those private live streams. I'm live every single morning, market open and the pre-market. Again, guys, if you are interested, this is going to be a really interesting time, and you guys really need to get prepared because this could get really gnarly back down. So again, link down below if you guys are interested. But then we have to take a look at exactly what we're seeing here with the Fed, the target rate probabilities for the September meeting. Now, if you guys follow me on Twitter, you guys would know that we've been kind of tracking this over here. Now, last week or over this weekend, we tweeted out that they were pricing in, or the probability to receive a 75 basis point rate hike before today was in the 60% range. It has now jumped to about 74.5. What that means is that now the market is expecting fully to have, or not fully because it's not at 100%, but it is expecting more. There's a higher probability to see that 75 basis point rate hike. Now, what that means is that, well, when you start to come in and look at exactly what happens when the Fed raises interest rates and you start to see these 75 basis point rate hikes, well, one, the housing market's going to slow down because, as we're going to take a look at over here, when the Fed raises the federal funds target rate, the goal is to increase the cost of credit throughout the economy. Higher interest rates make loans more expensive for both businesses and consumers, and everyone ends up spending more on interest payments. Now, take a family shopping around for a $300,000 30-year fixed rate mortgage. If the banks were offering them an interest rate of 3.5%, the total lifetime cost of the mortgage would be approximately $485,000, with nearly $185,000 of that accounting for interest charges. Now, if you take a look and say, well, what if the Fed had raised rates by 1% before the family got the loan? Now compare that to that $485,000 or $185,000 of interest payments. Well, the interest charges then jumped to $247,000, meaning that if you could afford that home at 3.5%, and that was kind of the maximum that you were able to afford as kind of denotated by the bank's lending standards, well, you can no longer afford that $300,000 home if rates go up, meaning that the demand side in the real estate market starts to come down and it eventually lowers prices. We've talked about this a lot. The other thing that we have to think about too is discount rates. It happens the same way with stocks as well. When you start to see the Fed raise interest rates, you see the discount rates that the different models, the discounted cash flow models, are using to kind of generate these present values for what stocks should be valued at right now. The discount rate goes up, meaning the multiple of those cash flows that are projected out goes down. So the present values of a lot of these stocks start to come down as well. So when you're in a rising interest rate environment, it's very difficult to see a lot of these stocks start to go on these massive fundamental runs because they're getting held back. That's why a lot of people have been talking about this value shift or looking into alternative investments, because with the rising interest rate environment, it's going to be very difficult to find these solid investments to the upside if you're just looking to buy and hold that are going to significantly appreciate. And again, when we come into September over here, caution, September is a historically a dismal month for stocks. So when you combine all of these things together, what retail investors need to do as a whole is really sit back and think to themselves, okay, this is the data that we have right now with the Fed. We know they're going to be raising interest rates. We know that they have kind of stuck to their guns and said they want to get inflation down to that 2% target rate. How are they going to do this? They need to keep raising interest rates, which are going to continue to make loans more expensive, to decrease the present value of a lot of companies in the present, which also provides a big opportunity for everybody to make some money on the downside as we start to see these interest rate hikes slowly start to affect equity prices. So again, guys, make sure you guys are prepared going into these next couple of months. We're going to be with you every step of the way. And a shout out to you guys in the group as well. You guys have been absolutely crushing it as well. Pythagoras and Invictus, that release has gone amazingly well for everybody. And again, if you guys are interested in joining and really learning how to take advantage of this market right now, make sure you check out that link down below. But again, guys, that's going to wrap it up for this one. Other than that, peace.